Welcome to the MPERS 2011 Tier Pre-Retirement Webinar. Before we start, here's a disclaimer. This presentation targets active employees hired by the state on or after January 1 of 2011. Leaving employment before retirement will change some of the provisions discussed in this presentation. Distinctions when they apply will be noted. So again, welcome to future retirees, members of the MoDOT and Patrol Employees Retirement Plan. My name is Jamie Mullen. I am a benefits specialist here at MPERS. My coworkers are Mary Jordan. She's also a benefits specialist, and she'll be joining this presentation later. Julie West, she's a communications specialist with the system, and Bev Wilson, who is a benefit audit specialist. We are going to be reviewing a lot of information about your retirement benefits through MPERS. I want to let you know that there are other resources available to you. A great way to get up-to-date information about your benefits is through our website, mpers.org. On our website, there's a handbook, and the handbook addresses the 2011 tier. It's combined with the year 2000 plan, but it addresses the 2011 tier retirement plan provisions. And then, of course, another way that you can get your questions answered is to contact MPERS directly. We're located in Jefferson City on 1913 William Street. You are more than welcome to come and visit with us in person. You could always email the system. Our address is mpers@mpers.org, and you can submit any and all questions to that email address, and they'll be answered promptly. Or you can call a benefits specialist at 800-270-1271. Okay, so the format of this presentation, we're going to start with a little bit of background information about the system, and then we're going to talk basically about everything that you would need to know before you retire. Once we've gone through all of those provisions, we'll walk you through the process of actually applying to retire, and then we'll tell you about certain provisions that affect you once you are retired or after you retire. So that's how the discussion will flow. Okay, let's start. So what is MPERS? MPERS is a defined benefit plan. First of all, MPERS is an acronym that stands for the MoDOT and Patrol Employees Retirement System. It's a defined benefit plan in that once you qualify to retire, you'll receive a benefit once per month for the rest of your life, no matter how long you live. Now, the amount of that benefit is based on your total service and your average salary. So there's something to take note of there that's really important. The longer you work and the higher your pay, the higher your benefit will be. Now, your benefit is based solely on your service and salary and nothing else. So any volatility that you hear about in the stock market, or the amount that you're contributing to this plan, or the amount that your employer is contributing to this plan, ultimately does not affect how much you'll be paid as a retiree. Again, that payment is based on your total service credit and your average salary. So we're going to talk a lot about that as we go forward. Now, MPERS administers 3 defined benefit plans. The provisions are very similar for all 3 plans. However, there's some important distinctions. The closed plan is for employees that were hired by the state before July 1 of 2000. Then the year 2000 plan came into existence, and it's for anyone hired on or after July 1 of 2000, but before January 1 of 2011, because that's the point in which you're a member of the 2011 tier, if you were hired for the first time by the state on or after January 1 of 2011. And again, this particular presentation is only focused on those 2011 tier members of the system that were hired on or after January 1 of 2011. So throughout your career, you may hear different things about the retirement plan. It's important that you know which plan that you're in so that you can figure out which provisions apply to you exactly. So how is the retirement system funded? So again, we pay you a benefit once per month for the rest of your life when you qualify to retire. The amount of that benefit is based on your total service and your average salary. So how does the system pay those benefits? Well, we collect money from you and your employer. Those are what we call the contributions to the system. Then MPERS has a professional investment staff. They collect those contributions and they invest that money with a long-term perspective so that they can eventually pay you a retirement benefit, but also so they can pay current retiree benefits, as well as benefits for folks that haven't even been hired yet. And so the contributions plus the investment earnings make up the MPERS Trust Fund, and that is the source of funds that is used to pay you your future retirement benefit. So how much do you individually contribute? So first of all, your employer contributes a good percentage of your pay towards this retirement plan. Your contribution is 4% of your pay, and that's a pre-tax contribution. So we do get the question often, do I have the ability to contribute more than 4% of my pay, or can I opt out of this and not contribute anything at all? And the answer to that is no. This is a mandatory 4% contribution that's set in Missouri state law, and there's no need for you to contribute more than that because, again, your benefit is based on your service and salary, not how much you put into this plan. And there's also no opportunity to opt out of this. If you are a benefit eligible employee by MoDOT or Patrol or by MPERS, then you are automatically a member of this system, and you are subject to those 4% employee contributions. Now, again, this is a pre-tax contribution, so it does reduce your taxable income by the amount that you contribute to this plan. Secure member access. So this is very important. If you have not set up an account yet on our website, I would encourage you to do so. Again, that website is MPERS, MPERS.org. Now, when you get to our homepage in the upper right-hand corner, there's a green button there called My MPERS Login. And if you click on that, you'll be taken to the Secure Member Access screen. And so what you want to do is you want to take a few moments to set up a username and password if you haven't done so already. And then once you're logged in, you're in what we call your secure area. So the very first thing you'll see is the account summary. And within the account summary, you get a little snapshot there. Number one, it tells you the date you were first eligible for normal retirement, and we'll get into how you qualify for normal retirement. It shows you how much that you've contributed to this plan so far. And it also below that tells you how much service credit you currently have in this plan. Okay, also within this secure member access, you'll notice on the left-hand side there's different options that you can click on. While you're an active employee, perhaps the most important thing that you can do is click on the section that says Estimate a Benefit. And this is where you can run projections based on how long you anticipate working of what your future retirement benefit will be. So I don't expect you to read all the details on this screen, but in the middle of that large circle there's different options. You can run an estimate for when you're first eligible to retire, and the computer will automatically tell you when you're first eligible. The second option is for you to pick and choose different retirement dates. Perhaps you want to work longer than first eligible, so you can ask the system to produce an estimate for a different date. Or the third option is you're going to separate employment before you even become eligible to retire, and you want to see how that affects your benefits. So you can do that as well. So once you've entered in the criteria there, you go to the bottom and you hit Generate Estimate, and then that pulls up a section called the Estimate History, and then every single estimate that you've run is listed there, and you click on that particular estimate that you've run, and then this is what appears. This is an estimate. Now there's an awful lot to look at on this screen, so I'm going to kind of break it down for you. But along the right-hand side in this gray bar is all of the important information that we've gathered in order to generate this estimate for you. So in the upper right-hand corner, we have your date of birth and your spouse's date of birth if you've entered in a spouse's birth date when you were running the estimate. It shows you your current employee contribution balance. That's your balance as of the day that you ran the estimate. It's not projecting what your contributions will be at a future date. Then in the middle there, you have the date of retirement that you've selected to run an estimate for. Below that is very important, going back to your service credit and your average salary. This is the portion of the estimate that shows you how much service credit you have as of the date of that retirement estimate. So this particular person had 32 years, 2 months, and 21 days of service. It shows in there your current sick leave balance. This particular person did not have any sick leave, but when you run an estimate, if you do have a sick leave balance, it'll lump that in there automatically. And then below that, it would show you your total service credit. So that's the time that you've worked plus your unused sick leave. And we're going to explain all that in much more detail coming up here. Then below that is your average salary. And again, we will talk about how we compute your average salary. But this person ended up with a final average monthly salary of $4,000 per month. The average salary, it looks at your highest consecutive 3 years of pay. So this particular person, it's taking their current pay and projecting it forward, and we're identifying the 3 years in which their salary is going to be the highest. Incidentally, whenever you run an estimate like this, it's going to assume no pay increases from the time that you run the estimate until the time that you retire. And so as you do naturally receive pay increases over the years, that would be a good time to go back into the program and run a new estimate, because the system will then pick up your new pay so you can see how that pay raise has affected your future retirement benefit. Then there in kind of the middle of the screen are your benefit payment options. And we will break those down, but essentially you're going to be picking one of those payment options that suits you the best. And it's showing you there your monthly benefit that you'll get once per month for life. It'll show you potentially a temporary benefit if you're eligible for that. And then a total benefit, which would be the combination of that lifetime base benefit and then that extra temporary benefit. And it also shows you survivor benefits potentially that you could leave to a loved one. Below that is a calculation of how we arrived at your benefit amount. Again, we take your service credit and your salary, and there's also a multiplier in there, which I'll explain. All right, so let's start to dig into this. When can I start receiving my benefit? So what we're going to talk about now is retirement eligibility. When do you become eligible to retire? Okay, normal retirement. So when I say normal retirement, I mean an unreduced benefit. So this is the point where one day you're working, you've qualified for normal retirement, and you could at that point stop working for MoDOT or Patrol and start collecting a retirement benefit. So one of the ways in which you qualify for normal retirement is under what we call the Rule of 90. So the Rule of 90 is the combination of your age plus your service equaling 90. So a quick example of that is someone who is age 60 with 30 years of service. They qualify to retire under the Rule of 90. Or let's say that you've started your career with the state a bit later and there's not enough time to get you to that Rule of 90. You could also qualify to retire if you're age 67 with at least 5 years of service. Now, I did mention a quick disclaimer at the very beginning of this presentation, and that disclaimer was that what we're talking about here are the provisions related to active employees, so someone that is currently employed. You'll note at the bottom of the screen here the exception. So if you left employment and you're eligible to retire, but you're not immediately eligible to retire. So in other words, you had at least 5 years of service, you're vested, and you're eligible for a future benefit. Those types of folks, we call them vested former members, and they are not ever eligible to retire under the Rule of 90. They would have to wait until the age of 67 to retire. Okay, now Uniformed Patrol, they are a separate category of employees, so to speak. They qualify for normal retirement when they reach age 55, provided that they have at least 5 years of service. Now, this classification of employee is subject to mandatory retirement at age 60. So there's no opportunity for a uniformed patrol employee to continue employment with the state beyond age 60. They would be forced to retire. And again, note at the bottom there, if you're a vested former member, so a uniformed patrol employee that left employment with at least 5 years of service, but they weren't immediately eligible to retire, they would then have to wait until age 67 to collect the retirement benefit. There's also early retirement. So when we talk about early retirement, you qualify to collect this a bit earlier in life. However, there is a reduction applied to it. So you qualify for early retirement at age 62, provided that you have at least 5 years of service. And when you retire early, your benefit is reduced by 0.5% for each month that you're retiring in advance of your normal retirement date. So for example, someone whose normal retirement date was age 67, but instead they're retiring early at 62. They're retiring 5 years early, so that's 60 months. That would equate to a reduction of 30%, a 30% reduction in their benefit for early retirement. Note also at the bottom that early retirement is not an option for vested former members. That group of employees would have to wait until age 67 to collect a benefit. There'd be no opportunity for early retirement. Okay, now I'm going back to that estimate. So I'm logged into the Secure Member Access, and I already showed you here where you can estimate a benefit. I just wanted to point out that those screens there show you the point at which you're eligible for normal retirement. So the calculation is done for you once you log in and run your estimate. And it'll even show you your eligibility for early retirement as well. Okay, now how much will my benefit be? So this is the benefit formula. So let's dig into that now. The base benefit formula. So base benefit would be the lifetime monthly benefit that you'll receive. So we take your total service credit times your final average pay times the 2011 tier benefit multiplier. So that multiplier is 0.017. So those three factors equal your lifetime monthly benefit. So when we talk about the years of service portion of that formula, that's the years and months of time that you've actually worked for the state of Missouri. That could include time that you've purchased or transferred potentially, and we will explain that a bit later in the presentation. And that could also include unused sick leave credit, which we will also explain a bit later. So again, that section there of your website, which details your total credited service, so that's a handy reference for you to check so that you know how much service credit you would have as of a particular retirement date. Next, the final average pay component. So this is the average of your highest consecutive 36 months of pay. So what we do is when you get ready to retire, or in the background when you're running an estimate, we take a look at every single paycheck you've ever gotten by the state, and then the computer isolates the 36 months in a row that were the highest. And we look at every single paycheck that you've ever received. Now, for most folks, that's usually their last 3 years of pay. That's when they're typically earning the most. But that's not always the case. So if you were perhaps earning more earlier in your career, we'll go back to that time in which you were earning more to calculate your retirement benefit. Or perhaps you had a period where you worked a lot of overtime, and that kind of increased your pay. If that's where your final average pay ends up being, we'll go back and capture that because it does include overtime in that calculation. So again, as you're looking at that retirement estimate on the right-hand side in that gray bar, it'll show you the final average pay as well as where in your pay history those 3 highest years occurred. Okay, and so again, on the estimate in that section where it says how we calculated your benefit, we take your total years and months of service credit times that 0.017 multiplier times your final average pay, and those three factors equal your lifetime monthly benefit. So that's the amount of money that you would receive once per month for the rest of your life, based on however long you end up working and whatever your final average salary would be. So again, I encourage you to run an estimate for yourself. Income replacement. So this is very important. You know, we don't always know exactly, we may not really have a good idea as to how our pay will figure into the future, because that's largely out of our control to some degree. But typically speaking, we do know or have a good idea as to how many years of service we may put in with the state. And so, you know, right now we're receiving a steady paycheck and we're receiving an income. And the hope is one day that we can be retired and we can generate different sources of income as a retiree. And so this defined benefit plan that you have here with MPERS, this is a source of income replacement. And you can calculate the percentage of your final average pay that will be replaced in the form of a retirement benefit. So for a 30-year employee, you take 30 years of service times that plan multiplier. So the 0.017 2011 tier multiplier, that's 1.7%. So if I take 30 years of service times 1.7, that tells me that this retirement benefit will replace 51% of my final average pay for the rest of my life. If I work, let's say 20 years of service, 20 times 1.7, that tells me that I would have 34% income replacement. Or 10 years of service would have 17% income replacement. And so you're going to have to take this benefit into consideration with other sources of income when you retire as well. One of those sources being Social Security. That's going to be a major source of income replacement. All of us members of MPERS, we and our employers on our behalf contribute to the Social Security system, so eventually we'll qualify for a benefit through them. So the combination of the MPERS retirement benefit, again, depending on how long you work, and the Social Security benefit is going to replace a good percentage of your working income, but it may not replace enough to meet all of your needs. And then so there's a personal savings component that goes into that as well. And you know, we're going to point you in different directions to where you can kind of boost the personal savings aspect of your overall retirement picture through the Missouri Deferred Compensation Plan or through other outside sources. But this is something to keep in the back of your mind about kind of putting the pieces together of your overall retirement picture, the combination of your benefit through MPERS, your Social Security benefit, and then personal savings. Now, the 2011 tier also has a temporary benefit, potentially, for some folks. The way you qualify for a temporary benefit is you must reach normal retirement eligibility before the age of 62. So this is someone that qualifies under the rule of 90 before the age of 62, or this could be a uniformed patrol officer that qualifies to retire at age 55. Essentially, they'll receive an extra, what we call a temporary benefit, until the age of 62. In addition to that lifetime benefit. So the temporary benefit is paid once per month and it'll go away at the age of 62. So this is the temporary benefit formula. It looks almost exactly like the base benefit formula, only the multiplier is slightly different. So we take your total years of service times your same final average pay times the temporary benefit multiplier, and this is 0.008. So those three factors equal your temporary monthly benefit. So now we're looking at an estimate here under how we calculated your benefit. You'll notice that the temporary benefit is listed below the base benefit. So we take your same years and months of service credit times the temporary benefit multiplier times the same final average pay, and those three factors equal your temporary benefit, so that when you add your base benefit to your temporary benefit, you have this total benefit that you can expect to receive until the age of 62. Once you turn 62, the temporary part goes away, but then of course that lifetime benefit continues once per month for the rest of your life. Can I leave my benefit to a survivor? So this is another very important question. And if you noticed earlier when we looked at that snapshot of your benefit estimate, there's several different payment options. So that's what we're going to talk about here in this section, is all of your different payment options. So if you run an estimate and you're married and you enter in your spouse's date of birth, the system is going to produce 5 different choices for you. Now you have to pick one of these choices that suits your situation the best. And I'll walk you through each of those choices. So what you're looking at here is your lifetime monthly benefit according to the one option that you've chosen, as well as your temporary benefit if you're eligible for that. So the combination of the base benefit plus the temporary benefit equals your total benefit. And then that last column on the far right-hand side, that's the amount that your survivor would receive potentially if you've chosen an option that includes a survivor benefit option. So that's the amount that the survivor would receive the month following your death. Okay, so let's kind of break these down in more detail. That first option listed there was called the life income annuity. The life income annuity pays you once per month for the rest of your life, and there's no survivor benefits upon your death. So, and there's also no reduction to your benefit either. You're getting your full benefit based on your years of service and your average salary. You receive that for as long as you live, and then upon your death, it ends. The next option is only for folks that are married, and there's what we call a joint and 50% survivor or a joint and 100% survivor. So as with all benefit payment options, you, the retiree, you get paid once per month for the rest of your life, no matter how long you live. But you can choose a 50% survivor or a 100% survivor. Now with this option, you take a reduction in your base benefit. So there is a reduction applied to your benefit. The amount of the reduction has to do with what your age is at the time of retirement and the difference in age between you and your spouse. And when you generate an estimate, the computer will automatically calculate those reductions for you. So you do take a reduced benefit. However, if you die before your spouse will get either half of your base benefit for the rest of their life as well, or all of your base benefit for the rest of their life, depending on whether or not you've chosen a 50% or a 100%. Now notice that the survivor benefit on that far right-hand column, that's half or all of the base benefit. It would never include any part of the temporary benefit. Only the retiree gets paid that temporary benefit. Now, another important consideration if you're married and you're considering either the 50% or the 100% survivor, you've taken a reduction to your benefit in order to provide your spouse either half or all of your benefit for the rest of their life. Let's say that your spouse actually dies before you. So at that point, the month following their death, we eliminate that reduction to your benefit and we start paying you the higher life income annuity amount. We call that a pop-up. So in other words, you're not stuck with that reduction for the rest of your life. You just inform the system that your spouse has passed, and then we adjust your benefit upward to eliminate that survivor reduction. Okay, guaranteed payment options. So this is a choice, or choices rather, that's available to anybody. So that could be a single retiree or a married retiree. I'll start by saying that it's not a very common option. This is a way in which that you could potentially leave a survivor benefit to anybody, not just a spouse. However, when you take a guaranteed payment option, you take a reduction in your benefit. So you still get a benefit once per month for the rest of your life, but it's lower than what the life income annuity amount would be. And then there's a guaranteed payment window that starts when you retire. So for example, the 120 guaranteed payment options. 120 payments, since we pay once per month, that equates to 10 years of guaranteed payments. So you retire and the system guarantees that we're going to pay 10 years worth of payments no matter what. So let's say you take that option and you live, God forbid, for only 5 years as a retiree. So now you have 5 more years of guaranteed payments, and we'll pay that to a beneficiary of your choosing. So they'll receive your benefit for those last 5 years. Now, the risks there is that you live longer than 10 years, which would be a good thing, obviously, but you would have accepted a lower benefit for the rest of your life. The guaranteed payment window has now expired. Now you, the retiree, will still get a benefit for the rest of your life, except that upon your death, there's no more guaranteed payments to leave to a survivor. And you are in, for lack of a better term, stuck with that lower payment for the rest of your life. So again, it's very rare. A small percentage of the population chooses it. Perhaps they have a condition that would suggest that they're not going to live very long, and this would be a way of leaving their benefit to somebody in the event that they died early. Now, the 180 guaranteed payment options, that's the same concept, but that extends the window out to 15 years. So if you have questions about that, let a benefit specialist know. We'll be happy to explain that a little bit better to you. Okay, how can I increase my benefit? So this is the point in time where I'm going to bring in my coworker, Mary Jordan, to explain that portion of it.
Thanks, Jamie. So we've already talked about how we calculate a retirement benefit. So now let's look at how we can increase that benefit. So service and salary are the key components that figure in with calculating your retirement benefit. So let's talk about the different options that you have for increasing the amount of creditable service to help increase your retirement benefit. So the first one is unused sick leave. When you retire from active employment, we're going to give you credit for your unused sick leave. Every 168 hours, we'll give you another month of creditable service. You can't use that extra time to qualify you to retire, but we're going to add it on when we calculate your benefit. And we'll show that on the estimates whenever you run an estimate and see that. So just remember, you have to retire directly from active employment to be eligible for unused sick leave credit. Vested former members do not receive that credit. So now let's talk about some prior public service. This could include some non-federal public employment, whether it's a purchase or a transfer, or possibly prior state service, benefit eligible state service that you might have had covered under Mosher's. So the first one is public employment in Missouri. This type of service has to be full-time, non-federal, public sector service worked in the state of Missouri. It could include a city government, a county government, a public school district, or even the University of Missouri system. When you look into this type of service, we can provide you with estimates on how much it will cost to purchase the service. We can provide you with estimates on how it would change your benefit. If you were to purchase it, will it allow you to retire earlier? Will it increase your benefit? We can kind of give you the information that you need to know whether it's going to be a good investment or not to purchase that service. If you have retirement credit in another retirement system, you may possibly be able to use that money to purchase the service, to transfer it over. May not purchase all of the service, but it may help pay for some of it. And you have some different payment options that you can use to purchase service, any IRAs, deferred comp plans, some things like that. So you can always contact a benefit specialist at any time. We can help you help get all the information that we need to help you through all of your options with that, tell you what your options are. It's also important to remember that any of the service that you transfer or purchase cannot coincide with employment with the state that you're already receiving credit for. So now let's talk about other benefit eligible state service that you might have. If you had any service that you worked on that was covered under MOSERS, you can transfer it to MPERS at no cost to you. It would be a day-for-day transfer. The benefits that you receive from either us or MOSERS would be the same retirement benefits, and we can talk about what the benefits are of having all of that retirement credit all in one place. You know, when you transfer service in, you get credit for the salary as well as the service. So having all of your service and salary all together to calculate your benefit is usually going to give you a higher benefit than if you had two separate retirements. Plus, it's going to help you with retirement eligibility, having all that service into one place. So a lot of times these types of transfers are handled when you first become employed with a new employer, especially under another retirement system between us and MOSERS, but you can actually transfer that time at any time throughout your employment, your career with the state government. So now let's talk about what happens if you die prior to retirement. So you do have some options for survivor benefits. If you are vested and you die directly while you're working from active employment and you're married, we will pay a joint and 100% survivor benefit to your spouse the month following death, and we pay that benefit for the spouse's lifetime. But say you're not married, but you do have some children under the age of 21, we will pay a benefit to those children equal to 80% of the benefits you earned up until that point, and we'll pay that to those children up until the age of 21. But if you're not married and you don't have any children under the age of 21, we will issue a refund of your employee contributions that you made during your career, and we will pay those to the designated beneficiary or as applicable by law. So that's what happens if you pass away while you're an active employee. But say, and you're vested, but say you're not an active employee, you are vested, but and you pass away. In that case, your spouse or beneficiaries would have to wait until you would have reached the age of 67 before those survivor benefits would begin to be paid to them. And now let's talk about if it's a duty-related death. Those usually happen on the job because of your job. There is a little bit of differences on the survivor benefits for the benefit of the survivors. There is no vesting requirement if you have a duty-related death. We're going to pay a benefit to a spouse equal to the greater of the benefit that was accrued, that joint 100% benefit that was accrued, or 50% of your final average pay. If there is no spouse and we're paying a child benefit, we'll pay the 80% benefit that was accrued or the 50% of the final average pay, whichever is greater. So now you've made it all the way through all of this information. Let's talk about how you apply to retire. So we do have a two-step retirement process. The only time you can retire is the first day of the month. That is written in state law that the retirement is only the first day of the month. We do pay benefits once a month, and it's on the last working day of that month for that month, basically. So the first step in the two-step retirement process is the step one notice of retirement, and that can be done from our website. Go to our website at empers.org, and then in the top right-hand corner, there is a green button that says My MPERS Login. If you click on that, it's going to take you to the login screen. If you have been on the system prior, you can enter in your username and password. If you don't remember what one of those are and you've set them up before, there are links there for forgot your username and forgot your password. But say you've never logged into your account before and you want to see some of your information. There is an Enroll Now button. Click on that. It will ask you to verify some information about who you are, and then you can set up your own online username and password to get logged in. And if you ever have problems with that, give us a call. We can help you get signed in. So once you're logged in, this is one of the screens that you're going to see. Down the left side is everything that you can do when you're signed in. So you'll want to go click on Forms, and then it will bring up this screen that you see right in the middle, and the online forms. One of those options here is the Notice of Retirement. So when you click on that, all the information you're going to need to tell us is right there on the screen. You're going to tell us what month and what year you're going to retire. And then at the bottom, if you're married, we need you to mark the married box. We need to know your marital status, married or single. But then we need you to give us some spouse information that we can use to calculate your benefits, give you your benefit estimate options. And then you hit submit at the bottom. It's also important to remember in the middle of that form, there's a message reminding you, asking you about any prior service credit that you might have. We need to make sure you have all of the service credit that you're eligible for. It needs to all be credited to you prior to starting this process. So if there's any service you want to purchase, we need to get that done before you do this. If there's any service we need to transfer from somewhere, we need to get that all done as well. So if you're not sure if you have all of that, give a benefit specialist a call and we can talk about it prior to starting the process. So when you go to start retiring, submit your forms. There are due dates based on the month that you want to retire. So say you want to retire October 1st. So that's step 1, Notice of Retirement. You can submit that form as early as June 1st, but you have to have it in our office by August 31st. So once you submit that form, there is a step 2 packet that we're going to send you with some other retirement election forms in it, as well as retirement estimates based on the information you gave us on that step 1. So one of the first forms that is going to be included in that packet is your retirement election form. That's going to let you tell us what kind of a benefit payment option that you want to elect, and Jamie talked about those different options earlier. You can also designate a beneficiary based on what options you elected above, which you would need to do, and then you're going to sign the bottom of that form. There's also a place for a spousal consent, and the only time that is applicable is if you're married, but you're not providing your spouse with a joint and 50% or a joint and 100% survivor option. If that's the case, then the spouse needs to also sign the bottom of that form saying that they understand when you pass away, they're not going to receive a benefit from us. They've signed off on not receiving that benefit. Another form that's included in that packet is a tax withholding form. Unfortunately, your benefit is taxable, both federal and state taxes. So that's where you can designate how much you want to have withheld from there. There is a public pension exemption in the state of Missouri that may allow you to not pay taxes at all, not pay Missouri state taxes at all on the benefit you receive from us, or maybe not pay as much taxes. That's not something that we administer. It is administered by the Missouri Department of Revenue. So if you have questions about whether you qualify for that, we would refer you to the Department of Revenue or your tax professional to answer those questions. When you retire, you also do not pay Medicare and Social Security taxes on the benefit that you're receiving from us. If you go to work for another employer and you're having earnings from them, you'll pay those taxes on that money, but you don't pay Medicare and Social Security taxes on the retirement benefit that you receive from us. Another form is the direct deposit form. This lets you tell us where you want us to deposit your money each month when we pay it. You'll tell us whether it's a checking or a savings account. You'll provide routing number and account number information to deposit in. So then we'll deposit that benefit on the last working day of each month. That's always something that you can change also, your taxes and your direct deposit once you're retired. So the next form is a $5,000 beneficiary designation. If you're retiring directly from active employment, we're going to provide you with a free, no-cost death benefit. All we need you to do is complete the beneficiary information so we know who you want us to pay whenever you pass away. And again, this is a form you can always change later if you want to change the beneficiaries, or if possibly a beneficiary's name has changed, you can always complete a new form. And remember, vested former members are not going to receive this $5,000 death benefit. It's only for those that retire directly from active employment. So now let's look at a designation of agent. This form is completely optional. It only works on the benefit that you receive from us, but it allows you to name it a primary agent and a successory agent if you want, somebody that you want to be able to act on your behalf if something happens and you become incapacitated and you're not able to make decisions on your own. So it basically works like a power of attorney, but only for our benefits here. So that form is available to you as well. So these are all the forms that you're going to get with the Step 2 packet. So we've already talked about when the forms are due for the Step 1. So what happens with the Step 2? So again, if you're retiring October 1st, we've talked about when the Step 1 packet is due. That Step 2 packet, all the forms in that packet are due to us on September 30th, just the day before you retire. Be sure you meet those deadlines. If you miss any of those deadlines, we may have to push your benefit off a month. So also when you retire, there are proof documents that you have to submit to us in order to facilitate your retirement benefit to be able to start receiving those. One of them is proof of age document for you, and if you're married, we will also need it for your spouse. That can include a photocopy of a Missouri driver's license or U.S. passport or birth certificate. We just need a photocopy, and we only need one of those for each, the member and the spouse if you're married. And then we'll also need a photocopy of your marriage certificate as well. So when you've completed all of that information, you're finished with everything with MPERS. But don't forget, if you're retiring from active employment, there are other things that you also need to do. Employee benefits, your employer has some information that they need you to fill out. There may be decisions you need to make on medical insurance, life insurance, your annual leave payout, and some things with cafeteria plan. Even if you're not expecting to take any of these benefits into retirement, there are still things that the employee benefits needs to handle with you. So we would request that you contact the employee benefits section at the phone number provided or your local insurance representative, and they can let you know what you need to do from there. Okay, well now let's talk about when you retire, is your benefit ever going to increase? Are you going to get any raises? Well, the good thing is when you retire, you get cost of living increases. That how much you receive will change from year to year, but the increase is calculated based on 80% of the change or the increase in the CPIU, which is the cost of consumer price index. It will be a minimum of 0 and a maximum of 5% based on that increase. And the raise that you receive will be on the anniversary date of your retirement. If you're a vested former member, remember that the cost of living increase you receive will start on your second anniversary of your retirement date. You don't receive it that first year that you're retired. It will come in on that second anniversary when you've retired. So now you've been in retirement, but you're thinking about maybe taking another job. So you want to know, what can you work after you retire? And the answer is yes. You can go to work anywhere you want, working as much as you want, making as much money as you want. However, if you go to work in a benefit eligible position with the state of Missouri, we'll have to suspend your retirement benefit while you're working. You can always work in a non-benefit eligible position, and that will not affect the retirement benefit that you're receiving. So if you're looking at taking another position after retirement, feel free to give us a call and we can let you know how that may impact your retirement benefit that you're receiving from us. So now let's talk about what happens if you get divorced. Unfortunately, the retirement benefit that you receive from us is considered marital property. A judge can award your ex-spouse up to 50% of the benefit that was accrued while you were married, the benefit earned during the period of the marriage. If they are dividing that benefit, they will issue a division of benefits order, and the payment to that ex-spouse will begin when you start receiving your monthly benefit. So their payments are based on receiving a portion of your retirement benefit. So if you're not receiving a benefit, they're not going to receive anything until your benefit starts. And those payments to the ex-spouse will stop when either party passes away, either you or your ex-spouse. So on the other side of that, let's talk about what happens if you get married after retirement. So this is one of the few instances where the benefit elections that you make at the time of retirement could possibly change after you've retired. So the only two instances where you can change them is if you were single at the time of retirement and chose the life income annuity, or if you were married at retirement and chose the joint and survivor option, either the 50 or the 100%, and your spouse predeceased you, then you have 1 year from the date of marriage to name a new spouse to receive that joint and survivor option. So as you go through your career, if you have questions about your retirement benefits, whether you're not sure whether something will impact your retirement, feel free to contact MPERS. Our office is located in Jefferson City, Missouri. You can stop by our office. You can give us a call and set up an appointment to meet with us to discuss face-to-face your specific situation. There's a lot of information available on our website, mpers.org. Or you can call the toll-free number and feel free to talk to a benefit specialist. We have different options of discussing your information. We can possibly do a video conference if you're not able to travel to Jefferson City, but you kind of want to have a face-to-face meeting. We can do it that way as well. So give us a call. We can facilitate any discussion that you're wanting to have. So we've talked about your defined benefit that you receive from MPERS. That's just one piece of your overall retirement picture. As you get closer to retirement, Social Security is going to fit into that retirement picture, as well as some personal savings. So you want to start looking into how all of that fits together as you get to retirement. And to find out information about your Social Security benefits, you'll want to contact them. There's a toll-free number listed there, as well as information available on their website. And you can feel free to contact them at any point throughout your career to have a better understanding of the benefits that you'll receive from them. Another option you have as being a state employee is your deferred compensation plan. Hopefully you have been making savings and investment options with them as well. Feel free to contact them either on the website listed or the phone number. You can get a consultation with your local deferred comp representative to see if you're in line for where you want to be for when you retire. So we've hit a lot of topics during this presentation, and we know it's a lot of information. So at any point throughout your career, feel free to check in with us if you have questions, and we'll be glad to answer any that you have. Some of the key takeaways that we want you to get from this presentation today is that the longer you work, the higher your retirement benefit's going to be. The more amount of creditable service, the higher your salary, the higher your retirement benefit will be when you retire. Log into your secure member access account, run benefit estimates that will help give you an idea of what those benefits will be. And choose a payment option that best fits your situation. Everybody's situation is just a little bit different. So don't make a decision based on that's a decision that a coworker or a friend is making. Make sure you look into all of your options and get the best payment option for you. So piece together your benefits that you receive from us, Social Security, personal savings, and also take into consideration the cost of your medical insurance when you look to determine your overall retirement readiness. the benefits, the expenses that you pay when you retire. It's a big part of how much money you need in retirement. So make sure you're taking all of that into consideration. So that does conclude our presentation today. We appreciate you taking a little bit of time out of your day to spend with us going over your retirement benefits. If you have any questions about any of your retirement benefits at all throughout your career, be sure you give us a call or contact us by email or on the internet and let us answer any of those questions for you. Thank you and have a nice day.